All right, let's just start off talking about where you see opportunities in bonds going into what we expect to be a rate cut from the Fed. Right now, you're seeing a lot of opportunity in the front end of the curve right now, the shorter end bonds. Does that thesis change at all if we get a 25 or 50 basis point cut?
Well, first of all, just taking a step back, there's lots of discussion on the tactical adjustment from the Fed today, whether it's 25 or 50. We see a credible case for either. But I think it's more important for investors to keep in mind the strategic path from policy here. And that is that the Fed is likely to adjust policy by 200 to 250 basis points over the coming year. And bringing that back to what the investment implications are, like you said, we do think that front-end bond yields stand to benefit the 2 to 5 year part of the US Treasury yield curve, but core bonds more broadly stand to benefit. And as investors, we have to really be, nimble, active, dynamic in our exposures. And what we're focused on is, does that adjustment from the Fed help to elongate the cycle? Then that will be beneficial for both bonds and risk assets. Or do we have a situation where the economy slows more than anticipated? And then in that case, bonds also have a role in portfolios because higher yields mean that they can provide protection against downside growth risks. And to take a phrase from your earlier guest, in that scenario, you probably want to be a bit more mindful, a bit more demure in your portfolio allocation and exposures.
That might be a theme of the show, more mindful, more demure. You have put out a note, I'm looking at it right now, really great note. I want to find out, do you agree, is this a normalization situation right now? We're going into a cut, this is normalization? Okay. We're going to show the chart, your data for the S&P's performance, the 2-year yield, and also the 10-year yield in a period of normalization after a first rate cut. So I'm just looking at the S&P right now, up 5% in 3 months, over 6 months, up 7%. With that kind of performance from equities, why are bonds attractive? I mean, that seems like really good performance from equities on average. Obviously, there can be outliers either way. But why are bonds attractive at all when you can get 5% over 3 months?
Well, one of the key important points that we make in the piece is that after the first Fed rate cut, what really determines what happens in the market direction is what's happening in the economy, and in particular, the evolution of the labor market. That's what we think the Fed is going to be focused on today, and that's what we're looking for in its characterization around the balance of risks tilting toward downside risks to the labor market from being more focused on upside risks to inflation. And in that sort of environment where upside inflation risks to inflation have calmed, downside risks to growth, and particularly the labor market, have increased, you do want to have bonds in your portfolio because they can perform that strategic role that they are supposed to, which is to buffer your portfolio when you do encounter episodes of downside growth concerns or market volatility. We saw that in early August. Bonds displayed their strategic advantage and their role then. We saw that last year during the US regional banking crisis. And so with that inflation emergency over, that is why we still think there is a credible case for more balanced exposures. Many investors in the last cycle tilted towards risk assets for return for higher yields, and those investors are still, rebalancing their allocations to take into account the fact that we are in a newer higher yield regime for fixed income.
All right, so you also mentioned there's some opportunities when it comes to corporate bonds. At the same time, we are seeing, just an economic slowdown. We're not exactly sure how deep the slowdown is or how much softness we're really seeing in the labor market. But when we're looking at corporate bonds right now, what area of corporate bonds are most attractive in your mind? Is it high yield right now? I mean, is this a time to try to get into high yield and benefit from that? Or do you want to go with a higher rated bond?
Yeah, it's interesting that you say how hard the hard landing is. The way that we actually look at it is more how soft will the soft landing be, because the current economic data indicates that the US economy is still fundamentally fine. Growth is slowing, it's decelerating, although the Atlanta Fed tracker is indicating that the US economy grew at around 3% in the third quarter. That's still a decent clip above potential growth. The labor market is cooling, it's not collapsing. So in that environment, we still think there's an attractive case to earn income from corporate bonds, investment grade credit, but also securitized sectors. And under the hood within those sectors, there's lots of interesting opportunities to be found. Actually, interestingly, within investment grade, you can find interesting opportunities in triple-B rated companies. This is the lowest rating cohort within that sector, but actually those many companies in that sector are working harder, demonstrating greater financial discipline to retain their investment grade rating. So investors can earn an attractive spread premium by having exposure to that rating cohort.